In 2008, one of the biggest robberies in human history took place. But not in the way we're used to. No masks were needed, much less weapons. The thieves wore suits. No one was arrested because that year the system showed its true face. This is the true story of how the banks stole the world, privatized the profits, socialized the losses, and got away completely unpunished. All of it with the approval of the United States Congress. It all starts with a seductive promise. Buy a house even without income, without a job, without collateral. It was the American dream, financed by a nightmare called the subprime mortgage. The banks gave loans to anyone. Literally, they called them ninjas. No income, no job, no assets. There was no mercy. Intentionally, the banks even mocked people.
I did a report on a bank in Maryland. Well, it's a national bank. It's a bank that, I wouldn't be surprised if a lot of people listening have their accounts there.
They had to pay a settlement to the government because they were intentionally targeting elderly black people to sell subprime mortgages to, and they called them mud people. There were all these toxic emails about how stupid they were and how they'd buy anything, etc., etc.
In the emails, did they call them mud people?
Yeah, and so they had to...
Many banks also offered refinancing to people, showing a lower monthly payment. But, of course, without warning them, they were switching from a fixed-rate loan to one with a variable interest rate. So it was only a matter of time before the government eventually raised interest rates, and the refinancing became practically unaffordable for most people. But making money with a mortgage loan was child's play. The banks wanted more. So they devised a new piece of financial engineering, one that was born in 1989 after an environmental disaster.
The Exxon Valdez spewed almost 11 billion gallons of oil. In the wake of the Exxon Valdez spill and a rash of lawsuits, Exxon took out a multi-billion-dollar letter of credit with J.P. Morgan.
J.P. Morgan, after lending billions to ExxonMobil at the time, ended up with that money tied up.
Every time a bank issues a loan, under banking regulations, it's required to set aside certain capital reserves for that loan. So JP Morgan, when it made the loan to Exxon, had to set aside capital.
If there's one thing banks hate, it's idle money. So a group of young people at JP Morgan found a solution. They sold ExxonMobil's debt to Burge. And that's how credit derivatives were born. They would become a gold mine, and at the same time a ticking time bomb for the banks.
The European Bank for Reconstruction and Development would receive compensation from JP Morgan for taking on credit risk and felt that was a good risk-reward proposition. And so risk was essentially dispersed. And why did JP Morgan do that? Because we wanted to free up our capacity to do more business.
This was a major financial innovation. Credit derivatives made it possible for a bank to sidestep capital requirements.
The banks used and abused this new system, but greed drove them to the edge of the abyss. Bankers merged credit derivatives with the early 2000s real estate boom. They packaged these bad loans they'd been making into sophisticated investments, CDOs, synthetic CDOs, tranches. Wall Street likes to make things complicated. That way the world thinks they're super smart and only they can handle it. Like the bankers. Actually, that's their mantra. Even when they're selling investments.
How can that be? The client doesn't even understand what the bank is doing.
These are very complicated derivative securities that take a PhD in physics or engineering to understand. And there are pension funds and mutual funds representing people's 401ks and retirement savings, trading the most complex instruments out there without fully understanding them.
So did
The people you worked with want unsophisticated clients?
Landing an unsophisticated client was the top prize. The fastest way to make money on Wall Street is to take the most sophisticated product and sell it to the least sophisticated client.
So what they did was like taking trash, spraying perfume on it, dressing it up, and selling it as gold. And everyone was buying it. Pension funds, even teachers' pension funds. Investors from all over the world piled into the trend. But one word sums up the whole structure much better: securitization. The business model basically worked like one insurance policy stacked on top of another. The banks bundled a lot of loans and turned that into a pool of debt called a CDO. They sold this to institutional investors and paid them a premium, a kind of interest, for taking on the default risk. Why did the banks do this? Simple: to make more money, just like JP Morgan did in 1989 with the ExxonMobil loan. By doing this, the banks could free up more capital to launch new deals. Those new loans carried higher interest rates than what the banks paid to the investors who bought their debts, the CDOs. Essentially, that is the core of a bank's model, known as the banking spread. Within this structure, another piece comes into play: credit default swaps, or CDS. Basically insurance for the investors who bought the CDOs. Imagine you're an investor who bought a collateralized debt obligation from a bank, but you're afraid of taking a loss, or even that the bank might go bankrupt. So you buy a credit default swap. If the collateralized debt obligation defaults, the person who sold you the swap reimburses you. Think of the whole thing as a bet, and it was a bet that landed on the worst side. Defaults surged and home values fell. It was exactly the shove that toppled everyone like dominoes. The banks paid the rating agencies to label their securities AAA, the highest and safest rating, even though inside those bundles there were thousands of bad loans.
They were handmaidens to Wall Street. The rating agencies get paid by Wall Street, by Merrill Lynch, by Citigroup, by Morgan Stanley, by Goldman Sachs, to rate the bonds that Wall Street creates. That sets up a clear moral hazard.
You wrote that Goldman took the worst stuff they couldn't sell. They repackaged it, took it to Moody's, and got a AAA rating?
Correct.
How did they know Moody's would rate it AAA?
They had helped design the models that Moody's used to rate the bonds. I've spoken with people at Morgan Stanley and Goldman Sachs who said, we helped the ratings agencies understand how these things worked.
So they were the teachers?
Yeah, they were the teachers.
So, in the domino chain, the banks would fail first, investors would demand payment, and then the insurers couldn't cover all the losses because the subprime mortgage market at the time was about $12 trillion. A global collapse would be fatal because no one knew the extent. Everyone was entangled in a web the financial system itself had woven. They wanted secrecy, pushed away regulation, and got lost in greed. AIG, the world's largest insurer, was one of the central players and avoided bankruptcy only because the US government rescued it, injecting billions of dollars in a bailout. It was in up to its neck, far too exposed when the housing bubble burst.
Like much of Wall Street, AIGFP fell in love with the money to be made in subprime mortgages. AIG didn't just buy billions of what became toxic mortgage-backed securities. People in its financial products division looked at their models and decided the securities were so safe they could make a fortune insuring other investors who bought them. Those private insurance contracts were called credit default swaps, and they would ultimately expose the conglomerate to about $64 billion in potential support for subprime mortgage losses. When the housing bubble burst, AIG couldn't meet its obligations.
Many said the banks and insurers themselves didn't grasp the scale of what they were doing, but the chance to make millions or even billions in this market was so tempting that they accepted the risk. It was like winning the lottery every month. Nobody wanted to give it up. Warren Buffett once called derivatives financial weapons of mass destruction. And he was right, because throughout the 1990s and the 2000s, derivatives became ticking time bombs disguised as financial innovation. No one regulated them. Alan Greenspan, the longtime Fed chair, opposed any interference. He even said the market self-regulates and that greed would correct excess on its own.
By the late 1990s, derivatives had become an unregulated market worth roughly $50 trillion. In 1998, someone tried to regulate them. Brooksley Born graduated first in her class at Stanford Law School and was the first woman to edit a major law review. After leading the derivatives practice at Arnold & Porter, Born was appointed by President Clinton to chair the Commodity Futures Trading Commission. In May of 1998, the Commodity Futures Trading Commission proposed regulating derivatives. Clinton's Treasury Department responded immediately.
I walked into Brooksley's office just as she put down the phone and the blood had drained from her face. She said, "That was Larry Summers. He has 13 bankers in his office." He delivered the message in a bullying way, basically ordering her to stop.
Regulation of privately negotiated derivatives between professionals is unnecessary.
The Fed chairman, Alan Greenspan, sided with the banks.
In 1999, the United States Congress repealed the Glass-Steagall Act, the wall between commercial and investment banking. Do you know why? Lobbying. That law had been created in 1933 after the Great Depression of 1929. Banks had been taking huge risks with depositors' money, and repealing the law came at a high price, a very high price. And not only that, years later the repeal would expose the hypocrisy of the American government. It also became a blank check for banks to privatize profits and socialize losses.
$33 trillion. A substantial share held by the 25 largest banks in this country. A large amount traded in those banks' proprietary accounts. That risk hangs over the nation's financial system. One day, with a thud, will wake everyone up.
At the center of the storm during the 2008 crisis was Dick Fuld, the chief executive officer of Lehman Brothers, one of Wall Street's oldest banks. He was aggressive, paranoid, and obsessed with money. Many said he acted like a god, untouchable. His arrogance may have felt justified. He started as a mere intern in 1969 and climbed the ranks. He took Lehman's stock from $4 in 1994, when he became chief executive officer, to $86 in 2007. Not bad. The firm went from a mid-sized player to the fourth largest investment bank in America.
You have to understand, you're talking about Dick Fuld. Dick Fuld made his fortune at Lehman Brothers. He was a billionaire. If you said, "I think you're wrong," he'd shoot back, "Are you a billionaire? Have you made $1 billion trading?" I have, and he had.
But behind that polished facade was something darker, a house of cards built on ever riskier bets. Fuld turned Lehman into a factory of toxic CDOs. The bank was leveraged 30 to 1. That means for every $1 of equity on the books, there were $30 of debt. In short, Lehman carried 30 times more debt than equity. But who cared? Fuld was blinded by his own hubris.
Our firm is strong today, and we will emerge from this cycle even stronger.
We've done it before, and we will do it again.
He said that right after releasing Lehman's quarterly numbers, claiming they had reduced leverage. Except it wasn't true, it was a fraud.
So they fudged the numbers?
Yes, I think they definitely fudged the numbers. They jumped on the trend and even called it a drug in their emails. It was a sham. an accounting gimmick to make themselves look better. They knew exactly what they were doing.
So they were hiding information from the public?
Yes, that was the conclusion we reached in the report.
Isn't that against the law?
If you file a misleading statement knowingly and a judge or a jury concludes that you did so, that is against the law. Yes, there was a basis for that claim. Yes, we pursued it.
Including against Chief Executive Officer Dick Fuld?
Yes, yes.
But nobody was arrested or charged for this?
No, there were no arrests, no charges, no jury trial, and no civil case where a jury heard and decided the matter. None of those things occurred.
This guy was just one of the few who made a fortune from the crisis. He knew exactly how dire Lehman's situation was. He publicly admitted he was shorting the stock, betting on a decline, and made millions when the bank collapsed. And time proved him right. Dick Fuld's reaction, his own words say it all.
If we get this right today, we'll squeeze some of those shorts. Squeeze them hard. Not that I want to hurt them. Don't get that, please, because that's just not who I am. I'm soft, I'm lovable, but what I really want to do is reach in, rip out their heart, and eat it before they die.
But the inevitable happened. In September 2008, everything collapsed. Lehman filed for bankruptcy and the house of cards fell. Thousands were laid off and panic took over the markets. And it was not just another bankruptcy, it was the largest in United States history.
When you talk about the Lehman bankruptcy, you're talking about the single largest failure of a financial institution in history. Total size of the bankruptcy, $693 billion. But
Mr. Fuld walked away unscathed, with millions still in his pocket. He took home roughly $500 million in pay and bonuses while the bank collapsed, and for helping ignite a global crisis that left millions unemployed and evicted.
Drive across America and you'll see old motels in countless towns. They offer cheaper, short-term stays. But for a growing number of homeless families, those motel rooms are no longer temporary.
Bottom line, since 2000, you've taken home more than $480 million. That's nearly $500 million, hard for many to grasp. Your company is now bankrupt, our economy is in crisis, and you get to keep $480 million. I have a very basic question for you. Is that fair?
Mr. Chairman, your initial question referred to this slide.
From there, he filibusters, claiming the figures aren't precise and that he actually received about $250 million. It's beside the point. He testified, walked in and out the front door. No charges, no fines. The institutionalized theft went completely unpunished. Hank Paulson, the former chief executive officer of Goldman Sachs, was a true apostle of the free market, a man forged in the belief that the economy's invisible hand should always prevail. But in 2008, staring into the abyss, the libertarian was forced to act against everything he had long preached. Lehman Brothers, Bear Stearns, Citigroup, and several other institutions were the first dominoes threatening to fall. The system teetered on the edge of a lethal domino effect. And Paulson knew it. Under his leadership at the Treasury, the government had to intervene with public money. First, Bear Stearns was hurriedly rescued.
Panic selling has brought Bear Stearns, an investment bank, to its knees. JP Morgan Chase buys the firm, but only after the government lends $30 billion to take on Bear's most toxic assets.
Federal Reserve has moved quickly to restore order in financial markets. Secretary Paulson is supportive of that.
Then AIG received a check for $85 billion. And there were still Fannie Mae and Freddie Mac, two gigantic institutions holding half of America's mortgages, also bailed out. To keep the global economy from blowing up, Paulson devised the Troubled Asset Relief Program, a $700 billion bailout package.
Paulson gave each man a single sheet spelling out the conditions.
Before they left town that night, they were told, return this document with your signature on it, and all 9 of them did.
The terms were extremely generous.
They don't have to modify any mortgages. They don't have to cap their own salaries, compensation, or bonuses. They don't have to do anything differently from before. They don't even have to agree to major regulatory changes. Basically, they are sitting fat and pretty.
And happy.
Treasury Secretary Paulson had just handed $125 billion to the nation's richest banks.
The system was saved, but at what cost? No banker went to jail, no executive lost his fortune. The guilty, the ones who created the crisis with greed and recklessness, were saved by the American people, literally with the people's money. Paulson, despite his nerve, played a central role in one of modern history's great paradoxes, saving the system while ensuring the culprit's victory.
It's fair to say that when hundreds of billions of taxpayer dollars are being spent, taxpayers have a right to know how.
Yes.
Mr. Cohn, how much has the Federal Reserve's balance sheet grown since September 1st?
It's gone from about 800 billion to 2 trillion.
What was that money used for?
That money was lent to banks and investment banks. It was spent on lending through the commercial paper market, and it was lent to foreign central banks that then lent dollars to their banks to relieve pressure in the United States dollar market.
Which institutions received it, and how much did each one get?
I don't know which specific institutions received it, but
Citigroup, at the time considered the largest bank in the world, received a bailout of $45 billion in taxpayer money. Apparently, the banks did everything on purpose. Even Citi's vice president was fired after repeatedly trying to warn the bank's top executives that they were neck deep in bad mortgages.
And I sent emails, I put it in my weekly report, I made committee presentations. I mean, I'm not a shy guy. I cornered people in the hallways, at the water fountain, and everyone said, yeah, we know we need to fix that, but nothing would happen. And through 2006 and 2007, the volumes kept increasing, and the rate of defective mortgages rose from 60 to in excess of 80%. 80% of these mortgages that we, in turn, were selling while giving representations and warranties that they met our policy guidelines, did not meet our policy guidelines.
That's misrepresentation.
That is true. In fact, it was fraud.
So the same financial elite that caused the collapse was bailed out. They called it a stabilization plan, but the right name would be a bailout of the guilty.
When I look back at things I could have done better, the first that comes to mind is that I never managed to convince the American people that what we did with the Troubled Asset Relief Program wasn't for those banks. It was for them.
It was to save Main Street. It was to save our economy from catastrophe.
Goldman Sachs, one of Wall Street's most respected institutions, sat at the center of one of the most blatant frauds of the 2008 crisis. While selling packages stuffed with bad mortgages, the infamous CDOs labeled as safe investments, behind the scenes, they were betting against those very assets. They profited on the way up and on the way down. They sold clients what they knew would blow up, and then immediately bet against their own clients.
$600 million of Timberwolf securities is what you moved. Before you sold them, this is what your sales team was telling each other. Boy, that Timberwolf was one lousy deal.
This was an email to me in late June.
Right? And you sold Timberwolf? No, you sold Timberwolf after as well.
We did trades after that.
Yeah, okay. Next email, look, July, it tells the sales force a top priority is Timberwolf. Your top priority to sell is that shitty deal. If you have an adverse interest, you must disclose it to your client. Inform that client about your conflicting interests. That's my question.
Mr. Chairman, I'm just trying to understand.
I think you get it, but won't answer.
When confronted by the United States Congress, Goldman Sachs executives couldn't even respond. Silence, cynicism, blank stares. It was as if shame choked them and left them dumbfounded.
Why would anyone trust you? I don't. If you came to me to sell securities and didn't tell me you had a bet against that same security, you don't think that affects my thinking?
Greed wasn't just allowed, it was rewarded. After the 2008 crisis, Goldman Sachs paid a $550 million settlement for its frauds. After that settlement, Goldman received $12.9 billion in bailouts and $10 billion in government loans. In June 2009, after the bank repaid the United States Treasury loan, Goldman made some of the largest bonus payments in its history, citing strong financial performance. Clearly, this was one of the largest transfers of wealth in human history. A covert theft carried out by banks around the world, especially against the American people. We are still paying the price. The financial market grew even more concentrated, bank power expanded, inequality exploded, and the financial time bombs were never fully defused. Greed continues, it just changed form. Although the crisis's worst effects were in the United States, it spread to the rest of the world.
After Lehman collapsed, products sold to investors in places like Hong Kong and Singapore lost most of their value. Milhares de pessoas comuns estavam prestes a perder milhões.
2008 wasn't just an economic crisis, it was a systemic crime, and the criminals are still at large, richer, more influential. When banks make mistakes, we pay and they profit, always.